Chief Investment Officer for CLS Investments. Welcome to our new monthly market review format. And today with me is Joe Smith, Senior Market Strategist. Welcome, Joe.
Welcome, Rusty.
Yeah, great.
So, we're already at November. How did it go for the markets?
Another good month, at least for the U.S. market. Another good month, following a great month in October. I think we kind of set the stage for a pretty good ending to the year. Some of the other asset classes, some of the diversifying asset classes didn't do as well, but for the stock market, we're having a nice little finish.
That's really awesome to hear. So, what are we looking at in terms of our market outlook going forward?
It's that time of year for the outlooks, isn't it? I mean, we do outlooks all the time, but really kind of our outlook going into 2016, which, by the way, we're doing our quarterly market outlook a little bit earlier than usual, so it should be out in the weeks ahead. But our outlook should not be a surprise to people who've been watching this. Our expectation for the U.S. stock market is for positive but below average returns. We're way into a very mature bull market. Valuations are high. It's hard to imagine we're going to get above average returns in this sort of environment. But other markets have lagged. International stock markets have lagged considerably over the last 5-6 years, and valuation is much more attractive, and we think that return potential is much higher overseas.
That's very interesting. So, I know obviously we're coming into another presidential election next year. So, what do we expect in terms of that to have a possible impact on market returns?
You've been getting that question a lot too, haven't you?
Yeah, I have.
Advisors are asking that question. Investors are asking that question. You know what? There's going to be so much analysis on what elections do to the stock markets. And I've in the past written about them, and I've spoken about them. And the reality is that I almost feel a lot of people will push out stuff that supports the view they already had. You know what I mean?
Yeah.
I think that's going to happen. But there are a lot of data points. There's like 36 data points. And, of course, there's so many different variables that come into play. But I think there's a handful of things that you can count on. So one thing is presidential elections do create uncertainty in the marketplace. And obviously the markets always have uncertainty, but during election times there's even a little more.
Yep.
And what happens is the market tends to spin its wheels and usually doesn't really go anywhere on average. So going into next year, assuming the presidential cycle sort of holds place, don't expect big gains in the beginning of next year until a little more clarity comes about who will be elected. So, of course, the big question that everybody wants to ask us, like, what's better, Republicans or Democrats? And there is a clear answer on this. And the answer that is better, it's the incumbent party. When they win, the market generally does a lot better.
Oh, wow.
So if there is a turnover, then the market generally does a lot worse. And it is pretty interesting how that happens. And so that's another big thing that kind of comes out of it.
Yeah, thanks for that insight.
Yeah.
So obviously we've also had some changes in terms of our investment themes going forward for 2016. So what are they?
Well, good setup since you're a member of the investment community. I already know you know them, and you helped create a couple of them too. We have 3 of them this year, and the first one, it kind of has a fancy name, but it really is kind of powerful because it's really bringing a lot of stuff into play, and we're just calling it the X factor. And it's really a play on the word factor because there's something called factor-based investing, which, of course, you're an expert on, and you're speaking and writing about it all the time, and you've been a big reason why we have this theme in place. But the X factor kind of goes into 2 things. One, if returns are going to be below average, how are we going to get enhanced returns in our portfolios? Yeah. And one way are through a lot of these smart beta ETFs that you write about a lot and we've been writing about a lot. And the second part is that factor-based analysis helps manage risk. And I think what we've seen in recent years is that volatility in the market's been below average. And when you have below average volatility, and again, this is another study you did with some of your research analysts, is that when you get below average volatility, it reverts back. So expect higher volatility. So if you can get higher volatility, you need additional risk management to complement our risk budgeting. So that's the first factor, X factor. I think it's a good one. The second one shouldn't really be a surprise to people. It's international opportunities. It's a very high conviction view for us. Yep. International markets, significantly better valuations, and the return potential is significantly better. And then the third theme is kind of an expansion of last year where it was tactical fixed income. It's now creative diversification. Means you still got to be tactical with your fixed income. Interest rates are still low. Credit spreads are still pretty tight. So you got to be tactical. But in addition to that, you got to complement it with alternatives and maybe even commodities. It depends. I mean, they've been pretty beaten down. So those are our themes, and I think you can agree they're pretty good ones.
Oh, yeah.
Yep.
Definitely going to be exciting for next year.
I think so, too.
Thanks again, Rusty. Thanks again for tuning in. We'll see you next time.